Hello and welcome to the All-in-One Loan Lunch and Learn presentation today. I'm so happy to have you. You may have noticed that you entered the meeting in mute-only mode, but that doesn't mean we don't want to hear from you. So if you have any questions, please utilize the Q&A section and we'll go ahead and answer any questions that you may have at the end of the presentation. Now, if you're a guest of a loan officer, you will be receiving an email follow-up from me later on today with a recording of this presentation so that you can replay it at your leisure or share with friends and family. Your loan officer will be CC'd on that email so that if you do have any additional questions about the product, you'll be able to reach out to the appropriate person. So with that, let's go ahead and get started. My name's Erin Wood, and I was part of the team that initially launched this product back in 2005. So I have a unique experience and perspective level to help loan officers not only explain this product to clients, but overcome any complexities with understanding how the product works. So please feel free to lean on me as a subject matter expert, and I'll be more than happy to help anybody that's interested in this product understand how it works and go over the features and the benefits that you're able to take advantage of. Now, I'd like to set the stage for everybody and just kind of review current events, if you will. Now, the U.S. housing market is approaching $11 trillion worth of mortgage debt. And there's 48 million households out there that owe a mortgage. So there are a lot of us out there, and we're in good company. But we do have $11 trillion worth of mortgage debt that we need to figure out how we can get out from underneath it. Now, one of the biggest culprits to being in mortgage debt at that amount is because of the forward amortizing mortgage product. Now, we've used forward amortizing mortgages in the US since 1938. It hasn't been innovated, and that's because it's reliably profitable for the banks to continue to implement amortization schedules in all of the mortgage products that are out there. Now, when you take a look at what an amortization schedule is, and you absolutely do not have to take my word for it. If you Google or look up at Wikipedia or even pull out your Webster's dictionary of what an amortization schedule is, it'll list it out for you in black and white. It's a repayment schedule where the interest portion is paid first and foremost, and whatever's left over is put towards the principal balance reduction. So in essence, we're paying interest first, we're paying our principal second. And that's how mortgages have been repaid, again, since 1938. Now, there is this myth that we believe in as consumers, and that is if we have a low interest rate and we have a low monthly payment, then gosh darn it, we must be getting a great deal, right? That's why we continually refinance and chase low interest rates. Well, you need to factor in our behavior as consumers because low interest rates do not come with low interest cost, especially when you factor in not only our behavior, but the forward amortizing loan. Now, the behavior of consumers is every 5 to 7 years, we refinance or we recycle our debt, more often for those that chase interest rates. Now, every column up on the screen in the graph that you see represents 1 year. Go ahead and count back 5 to 7. How much in interest costs are being paid versus principal balance being reduced? This is why we say that low interest rates do not come with low interest cost. It actually takes until around year 22, 23 until the monthly payment that we're making goes to equal parts interest and principal. And by the time we get to year 22, 23, we've refinanced already several times. So we don't ever get to that point. Now, forward amortizing loans are also one-way instruments, which means if you decided you wanted to prepay your mortgage at all, you're not going to easily get that money back. You would have to refinance or sell the home to recoup those costs. And if you're up against a financial burden, those are not viable options to choose from. So statistically speaking, we do not prepay on our mortgages because we do not want to part with that money if we need it down the road. Now, the impact of an amortization schedule, it actually eliminates the financial benefit we get from owning a home because of the interest costs that we have to pay back into it. Now, if you took an example of purchasing a home for $450,000, when it's all said and done, and I'll go over the specifics, I will have paid back $646,625 in total, including the $450,000 plus interest cost, Well, actually, in this case, it would be $400,000 that I'm repaying because in this particular scenario, I'm going to come in with $50,000 for this purchase. So I need to finance 400,000 of that. If I got a 30-year fixed rate mortgage today, the interest cost that I would have to pay would equal that $246,625. That's the interest cost that I have to pay. That's more than half of the amount that I'm borrowing. Well, if we break that down, the interest as a percentage of principal, for every $10 I borrowed, I had to pay back $6.17. So borrow 10, pay back 16.17 because you're paying back what you borrow on top of interest cost. Not that great of a deal actually when you think about it, because that adds 45% to the purchase price of what I was originally going to purchase the home for. So because of the interest cost, ultimately that purchase price was increased, or at least in terms of what I had to pay back. And that's assuming I have a 3.5% interest rate, which by today's standards, this would be a rate that you would brag to your neighbor or your friend about. That's a low interest rate. We would equate that to getting a good deal. And sure, homes are going to appreciate. That's a given. So by the time my home appreciates, let's just say 3% every year, then my home is ultimately going to be valued at over $1 million, which is great. But when I factor in the amount that 30-year fixed rate mortgage at 3.5% cost me, it actually was 23% my cumulative wealth that went to interest cost. So again, I paid handsomely for the interest cost for that low interest rate on my mortgage. And when you consider the piece of the pie that we have each month to go towards not only our living expenses, but our own retirement and our own savings. And we've gotten better as a whole over the last few years at savings, but there's still areas we can do better because America as a whole is actually vastly underfunded for retirement. And when we look at places where we can cut costs, if we switch a cable TV provider, we switch cell phone providers, those adjustments, that's not going to afford us our retirement. Sure, those are little adjustments we can make in the day-to-day. But really where the bulk of interest costs are associated with our mortgage, that's really where we can save some additional money. Just imagine what it would be like if you had an additional 10 to 15% of your monthly income to go towards other things in the household versus just paying mortgage interest. And that's where the all-in-one loan comes in. The all-in-one loan is definitely a smarter way that you can borrow. And that's because it allows homeowners and home buyers to achieve things that traditional financing was never intended for you to achieve. Most notably, the principal balance reduction. That's just the byproduct of the loan. Without changing spending habits, that's just what happens. But that also allows you a reduction in interest payments every single month, again, without changing spending habits. And you also have access to those available equity dollars or income accrued dollars, however you want to look at it. And all of that happens, again, without having to change your budget, your lifestyle, or your spending habits. We truly want to make this as easy for you to be as successful as possible in taking advantage of this product. Now, getting into where we came from with this product, and rest assured, this is not something we just thought up overnight and decided to bring to market. Not at all. We launched this product in 2005, and it was a different environment in 2005 when we launched it, if anyone remembers that time frame. First and foremost, we launched it as the Homeownership Accelerator, so that was the name of the product back then. And in 2005, there was this connotation in the mortgage industry where we had industry professionals encouraging leveraging equity, doing a cash out refinance. There were even some professionals that were encouraging borrowers to not pay off their mortgage, that was a better sound financial advice was to keep their mortgage on their balance books. So in 2005, 2006, 2007, the clients that did get into the loan were actually better able to weather the storm of 2008 and 2009 because they were less likely to be underwater on their homes. Now, if you fast forward to present day, this product is available in every single state in the nation, which is amazing. The only caveat to that is in Texas, where we can currently only offer it for second homes and investment properties. We're working with legislation to open it up to owner-occupied properties in Texas, but due to the homestead laws, there are some limitations. But we're actively working on that because we want our Texan neighbors to be able to take advantage of this as well. But outside of that, every single state in the nation has access to this product. The number one thing I'm most proud of, though, is that since 2005, we haven't had a single loss, foreclosure, delinquency at all. Not a single one. Now, I don't know if you understand the weight of that statement, but that's not something that Freddie Mac, Fannie Mae, FHA, VA, or USDA, they couldn't say that same sort of thing because America as a whole actually has the highest default rates of any other country out there that offers home financing. But in the all-in-one, we haven't experienced a single one. And that's a huge testament to what happens when we give more control over to consumers and borrowers, not only to use their money to their advantage, but to help them save an interest cost that would otherwise have gone to the bank. Now, what makes this product so different? What separates us from everything else? And it's because it's an offset mortgage. That's it. The all-in-one is an offset mortgage. And if you're unfamiliar with that term, that's okay. We're going to go over that on today's call. But an offset mortgage was designed to help borrowers achieve things that traditional financing was never intended for them to achieve, most notably a reduction in interest cost, a accelerated pay down of the mortgage, and flexibility and accessibility to use the available equity dollars or income accrued dollars at your discretion. Now, I'm going to quickly go over what an offset mortgage is. And it's just briefly home financing and personal banking combined into one account, which may sound crazy, but follow along with me in this presentation because it actually makes a lot of sense when you think about it, because we're already proficient at using checking accounts. And we already have experience having a mortgage. And we'll get into how the offset mortgage works as we go through this. Now, where did an offset mortgage come from? So this offset mortgage method has been used in other countries for decades. In fact, it was innovated in Western Europe. It migrated over to Canada. And then Australia, New Zealand also started to adopt the offset or all-in-one type loan. Now, our story begins in 2002 down in Australia, but I'll save that story for another time. But we did also bring to market an offset mortgage. But that doesn't mean that it's brand new to the US either. We've had offset type loans in the US prior to 2005. It was just in the commercial lending space. And they were known by different names. Typically, we reference them as sweep accounts, ZBAs, or zero balance accounts, or universal accounts. So unless you've purchased or financed a commercial property, chances are you don't realize these options exist. But we have had them here. Now, how a traditional offset mortgage works, so we'll get into that. And this is important because I want you as a consumer to understand, if you go home and do your research and you go online and you Google an offset mortgage or how it works, the likelihood of you bringing up articles from other countries is very high. And I know this because I've done it. And so the way traditional offset mortgages work are slightly different than how we have the all-in-one setup. And so I'm going to go over that with you so that you can make that differentiation and determination if this product is going to work for you or not. Now, if I was to go to Canada and purchase a home using their offset or all-in-one type product, this is what it would look like. I would have my mortgage and I would have a cash account of some sort. Now, that cash account that I have usually doesn't earn very much of anything in interest. They're typically not interest-bearing accounts. And there's also a certain threshold of deposits that you need to maintain. Otherwise, you lose the option to offset. So it becomes a stagnant cash account you can't really use. But where you do get the benefit is depending on the amount you have on deposit in your cash account, they're going to offset what they charge your interest at. So in this case, let's say I'm using my $400,000 example still. Let's say I had $100,000 in my cash account. They're now going to calculate interest on my loan at $300,000 versus $400,000. So this is a good deal. This borrower is probably going to save some time and money on their mortgage. But again, there are those adverse things that we still have to consider with this setup. One, it's a stagnant account you can't use. You're not earning interest on it, and you still have an amortization schedule, so you're not getting out of it that easy. Now, the way that we've developed the all-in-one loan and how it's slightly different, but before I get into that, I want to make sure everyone on the call understands this one thing because it's pretty important that you do. Here in the US, the banking system purposely keeps your checking account separate from your mortgage. And they do that on purpose because it's to their benefit that they can keep your money separate. Now, in the all-in-one, we've removed that invisible line and we say go ahead and let your checking account talk to your mortgage. Now, that might sound like I'm completely out of my mind, but I'm not. This actually makes a lot of sense if you think about it. Now, when we get paid every month, what do? We don't put our checks underneath our mattress. No, we put them in our checking accounts. Well, why do we do that? Because checking accounts are safe, they're secure, and they're easily accessible. Any other reason you would use a checking account, and it's going to fall into one of those three categories. Now, in the all-in-one, your money still stays safe, it stays secure, and it stays completely accessible. In fact, you get an ATM card that's also backed by the Visa logo, so you can use it as a point of sale or at the ATM. You can order personal checks, you can set up online bill pay. There's even a mobile banking app where you can take a picture of your check and deposit it into your all-in-one account directly from your phone. There's fraud protection features enabled in it. You can add additional users to the account. You can link external accounts. So really the functionality within this account is very similar, if not exact, to how you're used to using your checking account today. Only in the all-in-one, you're going to put your money to work for you versus the bank. And that happens with every time that you make a deposit into the all-in-one account. At 12 a.m., that deposit sweeps to the mortgage side of the account, reducing the balance by the amount of the deposit. Makes sense, right? Well, you're probably thinking to yourself, Erin, yeah, that makes sense, but I have to spend that money. I can't leave my paycheck against my mortgage all month long. And we agree with you. In fact, we want you to keep spending your money the way that you do today. Don't change a thing with your spending habits. So inevitably, when you spend money out of the account, using the methods that we have available, the balance is going to go up by the amount that you withdrew. Again, pretty easy to follow along, right? The beautiful thing about this product is until you spend that money, that's keeping the balance low, which in turn is going to keep the interest cost low. Now, how do we calculate interest? This is another area where we're set apart from any other product that's out there. So we are going to take the daily interest rate, which is established each month by taking the 1-month LIBOR index plus the margin that you choose. That is going to be times by the unpaid principal balance every single day. And then we're going to divide it by 365. And that's how we come up with that day's interest cost. So we're calculating the interest every single day. We're not charging it, but we're calculating it. Then at the end of the month, after we've made all of those daily calculations, we're going to add those up, and that becomes the interest-only portion that's automatically drafted out of the account the following month. So yes, you heard me right. You get to pay principal first all month long in this loan, and we settle up on interest the following month. We're calculating interest simply, you're paying it in arrears. This is the only loan in America today that will allow you to do that, and we don't ever change how we calculate the interest. For the full 30 years, that's exactly what we do. We calculate the interest based on that unpaid daily balance, and then we divide it by 365. At the end of the month, that's totaled up, and that becomes the interest cost that's automatically drafted the following month. Now, there are 4 different ways that you actually save money in the all-in-one account. First and foremost, every single deposit that you make goes towards principal balance reduction. So every single deposit reduces the principal balance. Now, the money that we're going to have to spend, the way we spend it, though, think about that. Ask yourself these 3 questions. Do you buy all of the food that you need for the month in one day? Do you buy all of the gas that you're going to need for the month in one day? How about your bills? Are all of your bills due on the same day? Chances are you said no to all 3 of those things, which means you're slowly and periodically spending money out of the account. Now in the all-in-one, that's to your benefit because your money is working for you, keeping the balance low. And then when you spend it, as you normally do, the balance goes up by what is withdrawn. Now, number 3, the third way you save money, that's your previous mortgage payment that you were making. Now, again, no change to budget, lifestyle, or spending habits, so that includes what you're budgeting for already as it relates to a mortgage product. In this particular example, if I had a $400,000 30-year fixed-rate mortgage at 3.5%, my principal and interest payment every single month is going to be $17.96. So these borrowers are already preparing and budgeting as if they have a $17.96 mortgage payment to make. But instead of writing out a check, sending that to the bank, having the bank take a huge portion in interest cost, and only apply a little bit to the principal balance, that $17.96 now gets to stay against the principal balance all month long. And then it's not just their previous mortgage payment that's also helping keep the balance low. It's also the positive cash flow, which is number 4, the money that you didn't need to spend. And sure, that's sitting in the account in the form of home equity dollars with the monthly P&I payment that you were previously making. But until you spend that money, that's going to keep the balance low, which in turn keeps the interest cost low. So 4 ways this loan is helping you save money that your regular checking account is not able to. Now, it's been my experience over the years working with this product that there are 5 reasons I continually see clients get into the all-in-one loan. And the number 1 reason, hands down, regardless of what the motivation is for the financing, is the ability to save an interest cost. And if you think about that for a second, we're all consumer minded. We all want to get the best value for the money that we spend. We don't want to just willy-nilly give our money away. And that's evident in how we shop. We're always looking for the best deal. If we were to go to the store to purchase something, but the cost seems inflated, we would probably say no to buying it at that store because chances are we could get it cheaper on Amazon or at another store down the street. So again, we're constantly looking for ways that we can save money and get the most value out of the money that we're spending. Yet when it comes to our mortgages, we're so caught up in that myth that we don't see the amount of interest costs we're actually paying. Number 2 and number 3, in my opinion, go hand in hand. And I say that because if you're a borrower that doesn't believe in paying off your mortgage, that's fine. There are other borrowers out there that still have that same school of thought. But I'd almost venture to bet that you are probably leveraging your equity to go build wealth in other areas. And if that is what you're doing, you're going to have access to those equity dollars 2 to 4 times faster than you would in a traditional loan, and you're saving money while you do it. Now, what happens when we're building equity? Yep, we're reducing our principal balance. We're reducing our credit risk. So if you're a borrower that's motivated to be debt-free or mortgage-free as soon as possible, this loan's going to help get you there 2 to 4 times faster, and you're not going to have to change your budget, lifestyle, or spending habits to achieve it. Now, number 4, this is really where I think the misconception that this is a HELOC or a HELOC alternative comes in. And it's in the fact that you have access to your equity dollars for the full 30 years. But really, the similarities between the all-in-one and a traditional HELOC begin and end with the fact that it's a two-way instrument, meaning money can come in and money can go out. That's it. That's where it ends. With traditional HELOC products, we know there's only a draw period of 5 to 10 years. And then we're hit with a repayment schedule or a balloon payment. Now, when we're presented with those options, what do we do as consumers? Yep, we refinance, which ultimately changes the trajectory of our financial goals, and we pay more in interest on the same debt. So those don't really help us out as consumers like we would hope they would. And in the all-in-one, those aren't ever going to be present, so you don't have to worry about it. However, you do have the ability to reach in and utilize those equity dollars to your advantage and at your discretion. And until you spend it, though, it's going to keep the balance low, which in turn will help keep your interest costs low. Now, I'm of the school of thought that I like to remove all emotion from any big decisions I make. I just think that's a good, sound decision to do. But there is an emotional reason with the all-in-one that has to be considered. And that's it becomes an unintentional safety net. And it's not lost on me how strange that sounds to hear somebody in the finance industry say that a mortgage product is a safety net. And if I hadn't had real life experience with it myself, I probably would be just as skeptical. But the way that the all-in-one is structured, it allows for a lot more grace for deposits to be made or not be made. If you're up against a financial burden, maybe you don't make a deposit for a month or 2 or 3, or in some cases, years. You have available equity dollars to absorb those interest costs. You don't have to make a deposit. Now, consider some things that life throws at us that we're not prepared for outside of the current situation. But what happens if we lose our job? What happens if the car breaks down? Or if there's a medical emergency? Or any of the number of things that life throws at us that we're just not prepared for? It can make a bad situation worse, right? Well, in the all-in-one, you have that added security and availability to reach in and use, again, those dollars to your advantage without needing to go and refinance. So the all-in-one is absolutely an unintentional safety net for those types of instances. Now, getting into the account access and servicing, we partner with Merchants Bank of Indiana and North Point Bank. They take amazing care of our all-in-one clients. In fact, they have a dedicated customer service line so that if you do have any questions, you're going to be talking to customer service agents that are fully aware of the product and how it works. You don't have to have anxiety about trying to explain the loan you're in. Not only that, but the closing piece is different. Traditionally, on a regular loan, we pre-fund or we have those interest costs for the following month already included in our loan documents. It's called prepaid interest. Well, in the all-in-one, there is no prepaid interest. We want you to get started using the account right away. So within 3 to 4 weeks from the funding date, you're going to receive your info packet. That info packet is going to include your Visa card, forms to order checks, set up direct deposit, add additional users to the account, go ahead and access the account for bill pay. You'll be able to actually start using the account within 3 to 4 weeks. So that process is a little bit different than what you might be used to. Now, I've said it before on this call that this is an offset mortgage with line of credit characteristics. Well, what do those characteristics look like? Well, first and foremost, we know that we don't have to deal with a balloon payment or forward amortizing repayment schedule. So we can just forget about those. Those are not going to be present. What you will notice is after 10 years, the credit limit starts to change a little bit. For the first 10 years, you can draw back up to the amount that you were initially approved at. After year 10, that credit limit's going to start to reduce by about 1/240, or the remaining 20 years, however you want to mathematically work that out in your mind. So that's how we're able to avoid a balloon payment. But you still have access to all of those equity dollars. Now, a question I'm often asked at this point in the presentation is, okay, well, Erin, does that mean that after year 10, I have to make an additional deposit into this account? And my answer is always the same, no, not at all. Because in fact, our all-in-one clients on average are reaching payoff anywhere between 8 to 12 years. Sure, we have some extreme cases where they pay off in 2 to 3, and we have some other cases where they've been in the loan since 2005. They're coming up on their 15-year anniversary. They're already in their credit limit reduction phase, but they continue to keep the account open because they like to have that optionality and flexibility available for them to use if in the event they choose. Now, up on the screen is a perfect example of how an average borrower has utilized this loan. They get into it and they don't change budget, lifestyle, or spending habits, so byproduct of the loan is that they're seeing a reduction in principal balance, which in turn reduces their interest cost. Several times throughout the loan, they decided to pull money out, and then they reached their $0 balance amount. And at that point, you've got two choices you can make. You can either close out the account and be mortgage-free. Congratulations, you paid off your home. Or you can continue to pay the $60 annual fee, which is waived the first year, and you can have access to the account and pay for it only if you use it in terms of interest cost. So up on the screen, you can see that this couple retired, and they didn't draw on the line for a few years. Then they decided to pull some money out to travel the world. So again, this is just a great example of how flexible the all-in-one can be, and this is some flexibility that a 30-year fixed-rate mortgage would never be able to afford you. Now, getting into the hot topic of interest rates. And I say that this is a hot topic because what are the first two questions we ever ask any industry professional when the topic of mortgages come up? What's my rate and what's my payment, right? So in the all-in-one, we've got 3 rate term options that you can choose from, and they range from the 1-month adjustable to the 3-year fixed or the 5-year fixed. Now, it's been in my experience that the 1-month adjustable continues to be the best deal, hands down. And I say that for several reasons. The first being that we use the 1-month LIBOR index for this product. And the 1-month LIBOR index may not be very widely known, so let me share some information with you. And of course, this information can be fact-checked if you wish. The 1-month LIBOR actually follows the Fed funds rate a lot closer than traditional mortgage products that follow the mortgage-backed securities or the bond market. So they act and react differently to market conditions. Over the last 25 years, LIBOR has had 4 increasing rate cycles that have lasted about 30 months on average. And there's been 4 decreasing rate cycles that have lasted about 35 months on average. So we know it actually spends more time coming down than it spends going up. Also, the LIBOR index is actually the index banks use to lend between themselves. We know banks are always looking out for the best deal that they can get. So if it's good enough for the banks to use, it's also good enough for us to use. And then lastly, the 1-month adjustable is the best deal, I think, because you get the biggest margin spread of 2.5 to 3.75, which is going to put your fully indexed rate today anywhere between 3.492 and 4.742, which is pretty comparable to other mortgage products that are out there. Now, because it's an adjustable, we're not just going to let it adjust indefinitely. That doesn't make sense. So we're going to cap it at 6% above your initial fully indexed rate. We also have a floor of 3.75. So regardless of what LIBOR does, the lowest you would ever pay is 3.75. Now, getting into an example, I think this is an important part because as they say, it is just math, it's not magic. So getting into the example, we're going to use the $400,000 loan amount. We're going to compare a 30-year fixed rate mortgage at 3.5% against the all-in-one, which is a 30-year open-ended, and the interest rate's going to be slightly higher than the comparable loan. I'm going to use a borrower and co-borrower with salary and expenses that leave them with just about 13 to 14% left over at the end of the month. So these borrowers are cash flow positive. Now in the example, when they make a deposit of their income dollars into the account, the balance is reduced by the amount of the deposit, but that deposit still remains completely liquid for them to use as they normally would. Remember, no change to spending habits, budget, or lifestyle. So inevitably, they're spending money out of the account and the balance goes up. By the end of the first month, their balance, though, is lower than what they started with, and they already have leftover cash or income accrued dollars or equity dollars, however you want to reference it, available to be used after the first month. We get to month 2 and the deposit goes in and the balance goes down and spending makes the balance go back up. Now the interest costs that we calculated for month 1 are going to be deducted in month 2. So their expenses are now including that $1,473 interest only payment. And of course, we end the month with a lower balance than what we had started with, as well as having available equity dollars continue to grow. We get to month 3 and the deposit goes in, the balance goes down, spending makes the balance go back up. Now take a look at the interest payment that we calculated for month 2. It's $1,465. For month 1, it was $1,473. What is the biggest motivation that we have as consumers to continually refinance and chase interest rates? Because we want a low payment. We equate that with getting a good deal. And in the all-in-one, your interest-only payments reduce month after month without you having to change spending habits because it's going to be calculated off of a lower balance. Now, if you were to just take a snapshot of these borrowers after 90 days in the all-in-one versus the conventional mortgage, my all-in-one clients have a better equity position already of almost a little over $6,800. And this is just after 90 days or 3 months. And you could argue that the longer you're in the loan, the more savings you're going to see. That's just math. But when you boil it down to the amount of years to pay off, we have a 30-year fixed rate mortgage or 360 payments compared to the all-in-one at 12.6 years or 148 payments. Now, I have the payments listed out in parentheses because as homeowners, we don't think about our expenses in terms of years. We typically think about our expenses in terms of months. So if I was sitting in front of a client, I would position it this way. Would you prefer 360 payments of $1,796? Or would you prefer 148 payments of about $1,100 on average? It'll be higher at the beginning, as you saw in the demonstration, but it's also going to be a lot lower towards the end. So as somebody that's always looking for the best deal and the best value for the money that's spent, what makes the most sense to you? 360 payments of $1,796 or 148 payments of about $1,100 on average? Then when you consider the total amount that you're paying back, not only what you're borrowing or financing, but the interest costs associated with that. In a conventional mortgage, interest as a percentage of principal, in this case, is 62%. So for every $10 borrowed, I had to pay back $6.20. Whereas in the all-in-one, my interest as a percentage of principal was only 31%. or broken down to the tens of dollars, $3.10 for every $10 borrowed. Now, the reason why I break that down into tens of dollars is because when we start talking about interest costs in the hundreds of thousands of dollars, it no longer becomes relatable. I don't know about you, but I've never held $100,000 worth of cash in my hand before, let alone 200,000, 300,000. But it's very likely that we've all had a $10 bill in our hand before. So my goal is to make this as relatable as possible. Now, when you take a look at the effective rate in the 30-year fixed rate mortgage, it was 3.5%. That 30-year fixed rate mortgage would have had to be locked in at 1.912% to save this customer the same amount that they were able to save in the all-in-one loan. And remember, the all-in-one loan had the higher interest rate to begin with, because it's not about interest rate on this loan so much as it's about the size of the debt that the interest is calculated off of. It's an offset mortgage, so you're putting your money to work for you versus the bank. Now, when you take a look at the wealth accumulation difference after all of the calculations, my borrowers in the all-in-one loan, they saved over $120,000. That's a lot of money. I happen to believe that that's life-changing money to families and households. That's kids going to college, that's investing in our own retirement, building our property portfolio, or heck, just doing something better for the family and household than giving that to the bank in interest cost. And really, when you boil it down to the difference between a traditional mortgage and the all-in-one, it really is how payments are applied. In a traditional loan, we're bound by that amortization schedule. The bank, well in advance of our loan closing, knows exactly what our monthly payment's going to be. And within that payment, they know how much they're going to take for interest and how much they're going to allow us to apply to the principal balance reduction. And by the way, it's closed-ended, so if you decided you want to make any extra payments, you're not going to easily have access to that money. And the all-in-one, we take a different approach. We say go ahead and utilize the biggest asset that you're likely to receive in life, which is the income dollars you earn. Put that towards the largest debt you're likely going to have in life, which is your home. Save money and interest costs, pay off sooner, and have accessibility to reuse that money if and when you need to without having to go through a refinance. Now, the question of who is this product right for? I think the answer is going to change depending on who you ask, but if you're asking me, I say every single American needs to know they have this option available. But does that mean I think it's right for every American? Heck no, not at all. If money burns a hole in your pocket or you're not a good steward of your money, this is not the loan for you. There are other products out there that will help you obtain home ownership, but this isn't the one that I would offer you. However, if you are a good steward of your money, and if you've qualified for a mortgage in the past, chances are you'll qualify for the all-in-one loan, and you'll be able to save money in interest costs and potentially time on paying your mortgage. Now, the small business owners and entrepreneurs, they love this product because of its flexibility and optionality. Same goes for those who have fluctuating income or commission earners. Even the small families down the street that just live within their means, they don't spend more than they earn, at the very least will save money in interest costs and again, potentially time on paying their mortgage. Now, once you've decided this is something you want to explore a little bit more, this is where the interactive simulator comes in. It'll give you the ability to put your scenario mathematically into the simulator, and we'll be able to return results and how you can expect the product to perform for you. Now, it's completely interactive, so keep in mind good data in equals good data out. Bad data in equals bad data out. So you want to make sure you're as accurate as possible in entering the information. I personally think it's great if you sit with your loan officers and at least for the first go through, talk about the type of information that's needed so you can understand the defaults that we've built into the system and understand what it is we're asking for. So again, you can have an accurate result for your particular scenario. Now, next steps. If this is a product that you're interested in, I would definitely recommend reaching out to the loan officer that invited you to today's call. And as a reminder, everybody that joined the call today will receive an email follow-up from me, including a link that you can replay this presentation. Your loan officer will be CC'd, so if you have any additional questions, you can reach out to them and get those questions answered. If you're a loan officer, thank you for joining us today, but you're not going to receive an email from me. We have a different path for you to take. Please reach out to the team and we'll give you the information on what you need to obtain further training, get your certification, and be able to offer this product to your clients. If you're a realtor, financial advisor, or any other type of fiduciary on the call, thank you again for joining us. And I will also send you a follow-up email with a link that you can replay at your leisure. If you learned about this online, though, please feel free to reach out to the team and we'll get you in touch with a certified loan officer in your area. So with that, I can open it up to see if anybody has any questions. If there are no questions, that's completely okay. We did go over a lot of information in a short amount of time, but I do want to thank you all for your attention today on this product. If there's ever anything that we can do to, again, help you understand how it works or go through any concepts with you, please reach out to your loan officer and the team, and we'll be sure that all of your questions are answered. Thank you all so much for your time and attention, and I hope you have a great day. Thank you.